The stock market is a noisy place. Prices rise, fall, and fluctuate by the second. Headlines scream, emotions spike, and everyone has a prediction. But the intelligent investor? He doesn't panic. He doesn't get swept away. He understands that behind the chaos, there's opportunity. In this video, I want to explore timeless lessons from Benjamin Graham's The Intelligent Investor. Graham wasn't just Warren Buffett's mentor. He was the father of value investing. And one of his core insights is simple. The market's wild mood swings don't have to control us. In fact, they can serve us if we know how to think. Let's start with the basics. What is a stock, really? It's not just a flashing number or a price that moves with every whisper on CNBC. When I buy a stock, I'm buying a piece of a real business. Imagine you own a local coffee shop. Would you suddenly slash your valuation just because someone walked by and offered less for it? Of course not. You'd look at your sales, your customer loyalty, your costs, the fundamentals. This is what Graham taught. The stock market might change every second, but the actual value of a business changes much more slowly. The intelligent investor separates price from value, and that difference creates opportunity. Now, to explain how irrational the market can be, Graham introduced a brilliant character, Mr. Market. Imagine you own shares in a business, and each day, your partner, Mr. Market, offers to buy your stake or sell you more of his. But here's the thing, Mr. Market is moody. One day, he's wildly optimistic, offering ridiculous prices. The next, he's depressed and selling at a discount. You're not obligated to accept his offers. In fact, you probably shouldn't most days. But when he's feeling irrational, when his price is far off from reality, that's your moment. That's when the intelligent investor acts. This is one of the most powerful mental models in investing. Mr. Market doesn't tell me what my business is worth. He simply tells me the price I could pay or receive. It's up to me to decide whether that price makes sense. Let's bring this idea to life with a case study. One of Graham's favorites, the A&P story. Back in 1938, the Great Atlantic and Pacific Tea Company, A&P, was a retail powerhouse. It had cash in the bank, real assets, and a strong business model. But the market got spooked. A recession, bad headlines, fear, and suddenly, A&P's stock was trading for far less than the value of its actual assets. It was like buying $1 for 50 cents. Graham saw that, and those who followed his logic, who stayed calm and analyzed the numbers, ended up making a fortune. Not by timing the market, but by understanding value. This leads us to some core takeaways for every investor. First, think like a business owner. Don't just buy stocks, buy companies. Second, separate market price from business value. Price is what you pay. Value is what you get. Third, don't react emotionally to the market. Volatility is normal. Panic is optional. Fourth, use Mr. Market. Don't be used by him. His offers might be tempting or terrifying, but they're just offers. You're in control. Fifth, buy with a margin of safety. That means purchasing well below intrinsic value, giving yourself room for error. And finally, focus on the fundamentals: earnings, dividends, balance sheets, cash flow. Not noise, not hype, not predictions. The truth is, we can't control the market. We can't predict where it's going tomorrow, next week, or next year. But we can control how we react. Graham reminds us that investing isn't about being clever. It's about being disciplined. So the next time stocks tumble or headlines scream about a crash, take a step back. Breathe. Ask yourself, what would a business owner do? Because at the end of the day, the intelligent investor isn't chasing the market. He's not a fortune teller. He's a realist. He knows the market will rise and fall, and he uses that rhythm to his advantage. Mr. Market is your servant, not your master. Buy wisely. Hold patiently. Think long-term.